Okay, let's go ahead and talk about a partially owned subsidiary with the differential for the year following acquisitions. In other words, we're going to go ahead and include income, dividends, things of that nature. Unfortunately, the tables in this PowerPoint are going to get harder and harder to keep a decent sized font, but we'll do the best we can. Okay, let's go ahead and continue with the example from the previous slideshow, the one titled Partially Owned Subsidiary with Differential. Again, to refresh our memories, we had the following. January 1st, 01, big company buys 60% of little company for $450,000. The fair value of the non-controlling interest on that date is $300,000. Little's book value is $500,000. Little has inventory which is undervalued by $50,000, FIFO basis, and property, plant, and equipment, 10-year life, which is undervalued by $100,000. We do our cost versus book value analysis, again the same thing we did the previous slideshow, and we find that we have that's how it plays out with goodwill of $100,000 for the company as a whole, $60,000 of goodwill for our portion. Now let's go ahead and assume that by the end of the first year, Little reports income of $80,000 and pays dividends of $20,000. Okay, let's go ahead and do our equity method entries first, just for old time's sake. First, we have to record the acquisition. So we debit investment in Little and credit cash for the purchase price. Next, we record our share of their income. Again, they reported $80,000 in income. We own 60% of their stock, so we get 60% of the $80,000 or $48,000. Dividends, they paid $20,000 in dividends. We own 60% of their stock, so we get 60% of the $20,000. And then amortization. Again, it's always going to be income, dividends, amortization. For the amortization, we've got two things going on. First, we have the amortization related to the inventory. Again, inventory was undervalued by $50,000. Our share of that was $30,000, and that's being written off entirely in the first year because we assumed a FIFO inventory basis. So we're going to reduce our investment account by $30,000 and reduce our investment income by $30,000. Next, we have the amortization for the property, plant, and equipment differential. Again, it was a $100,000 differential with a 10-year life, so that's $10,000 per year, and again, we own 60% of that, so our share of the $10,000 is $6,000. Okay, so let's go ahead and do our elimination entries. Again, first we have our S entry, and as before, we eliminate the subsidiaries' beginning of year owner's equity accounts. And we need to go ahead and create those differential assets. Basically, an inventory was undervalued by $50,000, and so we're going to go ahead and write up the inventory by debiting inventory. Likewise, for property, plant, and equipment, it was undervalued by $100,000, so we're going to go ahead and debit property, plant, and equipment net to increase it by $100,000. And we go ahead and record the goodwill of $100,000 as well. Now, the total of those debits, $750,000, is going to be split between the parent's investment in a Little account and the non-controlling interest in proportion to their ownership. Now, the parent owns 60% of Little, so the investment in Little account will be credited for $450,000, 60% of the total value of the firm at that time, and the non-controlling interest gets the other 40% of that $750,000. Next, we need to go ahead and do our A for amortization entries. First, we have that inventory differential. At the beginning of the year, we increase the value of inventory by $50,000. Since inventory is being accounted for on a FIFO basis, the assumption is that by the end of the year it's all been sold, so that $50,000 of additional value that we assign to inventory now gets transferred to cost of goods sold. Similarly, for the property, plant, and equipment adjustment, we wrote up property, plant, and equipment by $100,000. Since there's more of this depreciable asset, there is more depreciation expense as well. So we're going to go ahead and increase depreciation expense by $10,000. And again, we credit property, plant, and equipment net, since there's not a separate accumulated depreciation account. I for investment income. If you were to review the equity method entries that we made just a few minutes ago, we have investment income of $12,000, and so we're going to go ahead and get rid of that investment income, offsetting that against the investment in Little. D for dividends, the subsidiary paid dividends of $20,000, so we need to eliminate the subsidiary's dividends declared account, and again we're going to split that 60-40 between the investment and the non-controlling interest. finally, we have our income to the non-controlling shareholders. Now remember, we give the non-controlling shareholders their share, 40%, of the subsidiary's adjusted/realized income. We start with Little's reported income of $80,000, and then add or subtract to reflect the effects of the elimination entries. And in this case, we're going to look at those two A for amortization entries. We have $80,000 as our reported earnings. We put a $50,000 debit to cost of goods sold. That reduces our income by $50,000. And then we have a $10,000 debit to depreciation expense. That reduces our income by another $10,000. So the adjusted/realized earnings, $80,000 minus $50,000 minus $10,000 is $20,000. And the non-controlling shareholders get 40% of that, or $8,000. So we're going to go ahead and up in the income statement have this allocation called income to the non-controlling interest for $8,000, and we credit the non-controlling interest for $8,000 as well. Again, the subsidiary's earnings increased the parent's investment in a little account. The non-controlling interest is sort of the non-controlling shareholder's analog to the parent's investment in little. So if there's earnings that make the book value of the subsidiary rise, then the non-controlling interest rises as well. Now let's go ahead and post all these entries to the worksheet. These trial balances for big and little, I basically pulled these numbers out of thin air just with the few conditions that had to be met regarding the book value of the subsidiary and the investment balance and things of that nature. But by and large, a lot of these numbers are sort of chosen at random. And so let's go ahead and post our elimination entries. First, we post our S entry, just as we've done several times previously. And again, it can be useful to put a little S next to each of these entries to indicate where those numbers came from, which elimination entry those numbers came from. Next, we post our A for amortization entries. Again, we're going to go ahead and adjust cost of goods sold upwards by $10,000 up in the income statement. Likewise, we're going to go ahead and add $10,000 to depreciation expense up in the income statement. On the credit side, we're crediting inventory down in the balance sheet for $50,000, and we're crediting property, plant, equipment net for $10,000 as well. The I for investment income entry, the D for dividends entry, and the income of the non-controlling shareholders entry are just as we've done them previously. Again, getting the elimination entries is, to my thinking at least, the hard part of this entire procedure. Once you have the elimination entries in journal entry format, the balance of this is simply mechanical. We're taking debits and posting them to the debit column, credits and posting them to the credit column. Again, the things you need to watch out for, common stumbling blocks, is first, as far as retained earnings is concerned, we always adjust beginning retained earnings up in the statement of retained earnings, right in the middle of the worksheet. We never adjust ending retained earnings. We always adjust beginning retained earnings and let the effects sort of flow through to ending retained earnings. Second point of possible confusion is we have investment income down in the up in the income statement, and we have investment in little in the balance sheet. You need to keep those two separate in your minds, being sure which one you're supposed to be dealing with at any specific time. And third and finally, we have two accounts related to the non-controlling interest. We have the non-controlling interest equity-like account down in the balance sheet, very bottom of the worksheet, and up in the income statement we have the income to the non-controlling interest. So again, you need to be sure you're looking at the correct one of those two accounts as you do this. Okay, let's go ahead and work through our worksheet, just adding across each row. Sales, there were no adjustments, so we simply add across. Cost of goods sold, as reported, big $300,000, little $200,000 for a total of $500,000. But again, in addition, we also debited that for another $50,000, raising cost of goods sold to $550,000. Likewise for depreciation expense, as reported, total of $300,000 between big and little. In addition, we tacked on another $10,000 as part of our elimination process, and so depreciation expenses up to $310,000. Other expenses, there are no adjustments, so we simply add across. Investment income has to go to zero. We've got $12,000 Under Big's column for investment income, we have to eliminate that with an offsetting $12,000 debit. That number has to go to 0 in the consolidated balance sheet. Once we compute consolidated income, again, whenever we're getting a subtotal of any sort, we always work our way down the consolidated column. So we have $1.2 million of combined sales revenue, less $550,000 of cost of goods sold, less $310,000 of depreciation expense, less $270,000 of other expenses, for consolidated income of $70,000. Again, we do not add across big and little's totals for consolidated income. We bring our total down from up above. Next, income to the non-controlling shareholders. Again, we're tacking on $8,000 as a debit on our income statement. And then finally, the income to the controlling shareholders. Again, we work our way down the consolidated column. We have $70,000 of total combined earnings for big and little. $8,000 of that is being allocated or assigned to the non-controlling shareholders, leaving $62,000 to the controlling shareholders. Once we get that number, we transfer it down to the statement of retained earnings. Now we start working through our statement of retained earnings, again adding across. We've eliminated Little's beginning retained earnings, so we're left with Big's retained earnings. We've already got the income line filled in, so we jump down to dividends. And again, we've eliminated the subsidiaries' dividends, so we're left with the parents. And then again, ending retained earnings, we work our way down the statement of retained earnings. Beginning retained earnings of $800,000 plus income of $62,000 less dividends of $30,000 gives us ending retained earnings of $832,000. And once we get that ending retained earnings figure, we immediately transfer it down to the balance sheet as ending retained earnings. Now we can go ahead and work through our balance sheet. Again, cash and receivables, there were no adjustments, so we simply add across. Inventory, again, as reported, Big had $350, Little had $300, a total of $650,000. In the S entry, we wrote the inventory up by $50,000, but then in the A for amortization entry, we eliminated that additional inventory value. So basically, the adjustments to inventory are a wash, and we have inventory reported at $650,000. The investment in Little account, again, a valuable check figure here. When we add across that row, it has to net out to 0. If it doesn't net out to 0, you've made a mistake somewhere, either in the elimination entries or in the mechanical process of posting from the journal entry format to the worksheet format. Property, plant, and equipment net, as reported, we had $950,000 between Big and Little combined. We went ahead and wrote Little's property, plant, and equipment up by $100,000, but then took away $10,000 due to amortization or depreciation. So total property, plant, and equipment net on the consolidated balance sheet, $1,040,000. Lastly, Goodwill, we tacked on $100,000 of Goodwill on the consolidated balance sheet. And it bears repeating again, that Goodwill does not exist on Big's balance sheet. The Goodwill does not exist on Little's balance sheet. It's only created in the consolidation process. So again, next year when we do this, we will again have to reestablish that $100,000 of Goodwill yet again. Our liabilities, current and non-current, there were no adjustments, so we simply add across those rows. Common stock, as always, we eliminate the subsidiaries' common stock, leaving us with the parent's common stock. We already had the retained earnings number in place, so now we jump down to the non-controlling interest. We had $300,000 based on the beginning of year value. We added $8,000 as their share of the adjusted income, and then took away $8,000 as their share of the dividends, leaving us back at $300,000 again. Now, just because we can, let's go ahead and record the S entry for the following year, because basically, based on what we did in year 1, the S entry for the following year is now established. Basically, the S entry sort of brings us up to date or reinstates where we left off the previous year. So in 2002, again, first we're going to eliminate the subsidiaries beginning of year owner's equity accounts. Common stock is still $200,000. Little's retained earnings is now up to $360,000. Recall that last year retained earnings was $300,000. They had $80,000 in income. They paid out $20,000 in dividends, so their retained earnings was up to $360,000. Now we need to go ahead and record those remaining differential assets. The inventory. In the S entry, we created $50,000 in inventory. In the A entry, we took away the $50,000 of inventory. So basically, we're not carrying forward any inventory value. That inventory differential is gone forever. We never have to worry about it again. Likewise with the property, plant, and equipment. Last year, we debited property, plant, and equipment net for $100,000. Then in the A entry, we took away $10,000. So basically, we're carrying forward $90,000 of property, plant, and equipment net. Next year we'll carry forward $80,000, and then $70,000, and then $60,000, and then $50,000. Every year that's going to drop by $10,000. Finally, the goodwill. We debited goodwill for $100,000 in last year's S entry. We didn't amortize or impair that at all, and so that $100,000 of goodwill gets carried forward to the following year. Now at this point, the total debits are $750,000. I'm often at a loss to what to call this total of $750,000. It's not the book value of Little. The book value of Little at this point is $560,000. It's not the cost of Little either. So basically this is Little's book value plus or minus the remaining unamortized differential. But whatever we call it, we're going to take that total value of $750,000 and split it 60-40 between the investment and the non-controlling interest. Again, the parent owns 60%, the non-controlling shareholders own the other 40%. So the investment in Little account is going to be credited for $450,000, 60% of that total. The non-controlling interest, the other 40%, or $300,000. Now, it is just an unfortunate coincidence that the investment and non-controlling interest in the S entry is the same in 2002 as it is back in 2001. That was just an artifact of the way I selected these numbers, and quite honestly, after doing this entire example, I had no interest in going back and changing the example. Basically, the total value of the firm of Little is still $750,000. There has been a $60,000 increase in Little's retained earnings from $300,000 up to $360,000, but that's been exactly offset by $60,000 of amortization to the differential assets. So again, it's just a coincidence that those numbers are the same as previously. That will generally not be the case. Finally, just to, again, this idea of how things carry forward from one year to the next, look at how we dealt with a non-controlling interest in 2001 and see how that carried forward to the following year. Back in 2001, we credited the non-controlling interest for $300,000. Then we debited it to take away the $8,000 in dividends, and then we credited it for $8,000 to allocate to them their share of the earnings. So if you net those three things together, basically that gives us our $300,000 credit to the non-controlling interest in 2002. So again, this S entry sort of carries forward all of our work from the previous year, saying this is where we left off last year with our balances at the end of last year.